Right now, everybody's terrified about the potential chaos if Britain decides to leave the European Union, that big Brexit vote that they're having a week from today. Particularly since the polling suggests that the exit camp has a real shot at winning, although it looks like the stay camp may be gaining some momentum. But that's just judging by today's session, which I think turned up because of some news, and we're going to talk about it. I've been adamant that whatever happens in Europe shouldn't really affect the prospects of high-quality, domestically oriented U.S. companies that don't do much business overseas. And I have some stocks, as I mentioned at the beginning of the show, that I think work. But the Brexit vote is still incredibly important for the global economy, particularly if the UK decides to leave the Union. So to help you get a better understanding of what a Brexit would mean, we're checking in with a real expert, CNBC's own Wilfred Frost. He's co-anchor of Worldwide Exchange, which I do watch, and he knows, every morning at 5 a.m., and which, just to be clear, is very late in the morning for me. Wilf, welcome to Mad Money. Good to see you, sir.
Great to be here, Jim. My pleasure.
Okay, today was the first day that I've seen oil go down big and the market rally. And the market rallied, I believe, tell me if I'm wrong, that we got some sense today that maybe UK stays.
Well, the sum total of the last 2 or 3 weeks has been big momentum behind the leave camp. At the margin, the last couple of days, perhaps Remain's got a little bit of a bounce back, but sterling's a pretty good indicator. Sterling started to rally midday, and you're right, lots of other risk assets responded off the back of that.
It was really incredible to see it. Now, there's a couple situations. I know U.S. banks are being involved, but there's some devastating trading that's going on in Lloyd's, at Barclays, RBS. These things, Wolf, they're down like 40%. Now, that must mean that is it actual risk, systemic risk to these banks?
So I don't think the first thing to point out is on the 24th of June, the day after the vote, if we get an exit vote, nothing immediately happens.
Okay.
This is just a referendum that would then spark negotiations for how Britain leaves. So nothing legally systemic is expected the next day. The question really for those big banks in the UK is, does London's position as the main financial centre of Europe come under threat? Because if Britain loses, do you see retaliation from the French and Germans wanting to claim market share in terms of what banks going forward? And that is a big debate. Broadly speaking, the UK has a big trade deficit with the rest of Europe, which means that it's unlikely to see really tough barriers imposed because you want to see, German cars want Brits to keep buying those products and stuff. But banking itself, we have a big surplus. So that is the sector which is most likely to face retaliation.
But the U.S. banks have been trading almost as lockstep, and now they do have some exposure, right?
Yeah, the US banks have exposure. If you look at the exposure to Europe as a whole, they don't break out the UK on its own. Goldman Sachs is the highest, 27%. Bank of America.
And that's been the hardest hit.
It has been hit. And I think, the question there is, do they have to move a whole load of their cost base to somewhere else in Europe? JP Morgan CEO came out and said that he's got 16,000 people in London, up to 4,000 might have to move. It all depends, though, on that negotiation in terms of what the Germans and the French say afterwards. And, it's a cost base there. It's not so much a revenue base for these banks.
Okay, but what's important in terms of both the revenue and cost base is some companies you showed me, Penske Auto, which is unlike the other auto companies, turns out to have very big exposure, 33%. Xerox has 20%, which is surprising. eBay, 16%. In the world that I live in, cutting numbers means stock goes down. Theoretically, I know you said that it's a long-term divorce. It's not something that decree does not. But the numbers could come down for these.
Yeah, so those companies, exactly right, they have pretty high exposures to the UK. The difference for them compared to the banks is that predominantly they have, like Ford, has a plant there, it makes cars there, and it sells them in the UK. So the big pressure of renegotiating trade deals with the rest of Europe doesn't really bother them. If the pound falls, their US dollar earnings fall, but it's 10% or so. If you get a 0.5% off GDP in the UK, that hurts your car sales. But it's not a possibility of falling off a cliff if Germany and the UK say, we're not trading with you anymore.
True, but the number of cuts will move these stocks, and they've been weaker. This group's been weaker. Now, is there any scenario where nothing happens? That, Brexit, UK, the leave vote wins, and yet, because everyone liquidity, people are all prepared now?
Yeah, I think that's a possibility. But the thing is you have this huge uncertainty whilst this negotiation happens. I mean, the pound has been tracking that uncertainty quite significantly, I would say, over the last couple of weeks. Since the start of the year, the low was 139. the high about 147. We're at 142 today. And that kind of paints that picture of how much people expect this to happen. So there's still quite a lot of confidence, I would say, when you look at sterling in terms of what this outcome is going to be and what it might mean, because we're above the February lows. That's a big difference from, you know, where we're seeing bond yields or what we've seen to German equity markets in the last couple of weeks.
You know, you had a great piece this morning. You do. I mean, you guys do, you and Sarah, tremendous chemistry, really fun. I changed my whole day around. I used to work out at 4, now I work out at 5 and do hour work before you, so I watch you. And it's very clear that you did a really good package about Trump. Didn't necessarily say that, you just talked about kind of, it's like civilization and its discontents.
Right. So I think that you know, there are similarities between the two. There's no doubt about that. But the key difference between the rise of Trump and Brexit is that the vote in the UK is about sovereignty. Here, it's about dissatisfaction with the political elite in Washington who are elected.
Right.
You know, in the UK, it's dissatisfaction with unelected people outside of the country. Whoever wins between Clinton and Trump doesn't question America's sovereignty. Right. You know, here, this is British people thinking we want to claim back power, not necessarily criticism of people within their own country.
All right. No, well, my wife and I were in London not that long ago, and we counted cranes. There were 47 cranes in London. And she said to me, she's in real estate, Jim, if there was ever a top, it's 47 cranes. I mean, there is some irony, isn't it?
Yeah, a lot has gone up, particularly in the commercial sector, which, of course, has those huge cranes. Interestingly, if you look at the data, speak to some property experts, as I have done, volumes have dropped quite significantly in the last...
Volume dropping significantly is the beginning of what causes a downturn.
But prices haven't too much.
But that follows. Price follows volume.
It can do, but when you have a big event like this, it could be, let's hold and wait and see what happens. And there's also an interesting thing when you talk about the residential market. Lots of stories that there's a lot of foreign money sitting on the sides because they're waiting to see if a Brexit does happen, not if it doesn't happen, because if it does, they see the fall in the pound and they can get in at the market at a much better rate. So you might see a fall in my value because I'm now in the US, because this pound might fall. But if you're sitting in the UK, the pound will fall, your property price might go up if foreign buyers come in at that point. But property is going to be a big question. It's a big question on voters' minds as well.
All right. Well, look, you are a joy. I'm glad you came on the show. I do love watching you guys. It's really a must-watch if you're trying to figure out what's going to happen every day.
You're too kind, Jim.
No, look, I'm truthful. That's what I am. That's Wilfred Frost of CNBC's Worldwide Exchange. Thank you for explaining all that to us, Wolf.
My pleasure, Jim.
Good deal.
Great to see you.
Stay with Cramer. Booyah! Jim Cramer here from Mad Money. Thanks for watching CNBC on YouTube. Click here to subscribe and get the jump on my exclusives with CEOs, plus market news, investing advice, and a whole lot more.